The following keynote is Resourcing Global Entrepreneurial Ecosystem to Accelerate Your Global Business Focus. And we're very, very honored to invite our next speaker, Dr. James Liu, to conduct this speech for us. Ladies and gentlemen, your applause to welcome Dr. James Liu.
Thank you very much. And Deputy Director General Lin, Professor Huang, and special guests, and all the other young people. Good morning. How you doing? That's great. I think I love to see all the young people. It is really great. It's my pleasure to see all of you here participate in this great event. And I indeed admire very much the organization organized this event, the international event, the AAN networks, which is very useful to a young entrepreneur and startup company. I personally got involved in innovation and incubation back in 1993 when I was invited to be the CEO of Hong Kong Industrial Technology Center, which is basically an incubator. And at the time, it was a brand new idea. It was the first incubator in Asia. And we were trying to figure out how to make incubator works. And I worked there for a long time, for about 8 years. And eventually, we figured out that to be successful in doing a business or in doing a startup company, there are a few things that we need to follow, which is what I'm going to share with you today. And I thought that's a very precious experience. And I hope all the startup company will not waste their time or be able to engage in the activity that is directly useful to their success. Over the number of years after my career with the Hong Kong Industrial Technology Center, I was involved as an investor. I invested in a few internet companies back in 2000. And then I transformed myself into a fund manager, which managed stock investment fund directly into a stock market. However, I continue my personal interest in making business work. What a business should do in order to make a business successful. And that was my personal interest. In fact, that's also directly related to how I invest in the stock market, because I need to have a set of criteria to select a good company. Now the question is the definition. What is a good company? And when we start a company, our goal is to make or transform our company to become a successful company. And I always heard from the venture capital world about the success rate of a new startup company. And people accept the fact that 10% of success rate is acceptable. And I don't think that's good enough. 10% is not acceptable. It's not a great percentage of success rate. We should try to make it at least 50%. We want, when you do a manufacturer, for example, in Hong Hai or Foxconn, if you build the iPhone on the assembly line, can we accept 50% of success rate or 10% of success rate? That is impossible. You can make an iPhone with 50% success rate. The same idea applied to new startup company. We should have an algorithm or mechanism that would be able to help new startup company to succeed in more than 50% because there is a way or there is a rule of nature that govern the success of a new business. There are rules of nature that govern the success of business. And that set of rules need to be discovered, need to be quantified, so we can repeat the same set of rules for a new startup company. So that would help our new startup entrepreneurs to succeed on what they are doing. Most of the time, people or new startup company make the same mistakes again and again, and we should avoid that. So what I want to share with you today is a few tips, and I think that's very important in doing a new startup company. First, we do not have a regular or consistent way of doing things in a startup company. And almost every startup company started out without knowing exactly what to do in the next 5 years. Therefore, everybody spend their time alive to look for solutions, repeat it again and again. And that is a waste of our experience and our knowledge. So what I want to share with you this morning for this 30 minutes, anybody who are going to remind me after I use up 30 minutes? Because anybody? Okay. Just raise your hand so I know my time is up, okay?
Doctor, actually, to your right, there's a plasma. Down on the stage, to your right, there is a plasma TV screen.
Oh, okay, very good, excellent, thank you. So I feel easy now. Otherwise, I worry about overuse your time. All right. Okay, so I want to show you is some of the tips that help us. I have reviewed many business plans from startup company. They almost write in the same format. They repeat the same thing. When they talk about SWOT analysis, they almost say the same thing. The reason for that is people were not trained to tell exactly what it means in the SWOT analysis. In our 5 forces analysis, they all do the same thing. So which are good tools, but we never use them in an effective way. So what I want to share with you is to make sure that we make use of tools effectively to our advantage that would help the business to succeed. Okay, most of the time I see the business plan as a wishful thinking description. And a lot of times they make things more complicated than it should be. When you start a company, you only have a few people. Why the business plan has to be that complicated? Some people even show 10 years of Excel about the future projection, the profit, and the cash flow. It's impossible for you to know next 10 years. My good friend who is the chairman of the Advantech, such a large company, Yanhua, 2395. Such a large company, he told me he couldn't even see anything beyond 5 years. So every time when he does a business plan, he only covers 5 years. And every 5 years, he needs to readjust his strategy and his focus. So as a new startup company, I don't think we are capable of doing a projection over the next 10 years. So normally, I would suggest that we shorten your plan and to be something that is more reliable, that is more believable. or something that you can put your hands around. So I normally divided the business development into 2 stages. The first part I call ramp-up stage, preparations. Second part is called steady state stage. Your goal, entrepreneur's goal, is to be able to make a profit consistently when you reach steady state. Before you reach steady state, you are in the ramp-up stage. And the ramp-up stage, in other words, you are spending money. And you need to prepare enough cash for you to survive the ramp-up stage in order to get you to the steady state stage where you make money. So when you talk about startup plan, you want to be able to prepare a plan that shows people how much cash you need for you to get over the ramp-up stage and how would you do it. That would give the investor the idea how much longer or how much time he needs to be able to live with you until you survive the ramp-up stage. So normally there's 2 stages, ramp-up stage and steady state stage. When you reach a steady state stage, you should be able to show people it's a profitable business. For every $100 investment, you should be able to get at least $10 in return. So that gives the investor confidence. If I can work with you, then that's the first part. So normally we break them down into a ramp-up and steady state. Steady state, you can show them it's a profitable business, and I need this much cash to allow me to survive my ramp-up stage. And that will be clear to the investor how much money they have to put in order to be able to get the profit in the future. Now, in terms of the plan, the startup plan, number one, the most important thing is strategy. But very few people are capable, or very few people do not emphasize enough on the definition of strategy. Strategy has 2 components. One is a pick and choose. The number 2 is direction, how fast I'm going to move with my plan. Now, what's a pick and choose? Pick and choose means you define what you do and what you don't do. Most people only define what they want to do, and they never try to define what they should not do. What you should not do is very important also. Let me take one example, like Southwest Airline in the United States. The Southwest Airline was successful because they clearly define what they do and what they don't do. And because they clearly define what they do and what they don't do, they were able to save money from normal airline operation and share the advantage of those savings with their customers. So they win and customer win, and that make a business successful. So Southwest Airlines was able to achieve the kind of financial goals they have because they clearly define what's necessary, what's unnecessary. For example, and the way to achieve the goals. For example, they only serve point to point. And they remove all the unnecessary service, which normally is unnecessary cost to those people who just want to get from point A to point B. And also, to achieve such a saving, they also need to have the pick and choose of what they do in order to help them achieve the financial goals. For example, they only buy limited model of the aircraft. They only buy 737, for example. So they have a saving of maintenance, parts cost, inventory. And they only pick the secondary airport to serve. They don't go to rent the most luxury or expensive airport. Because for the customer, the only thing they want to do is get to point A to point B. So after they do this pick and choose, they do and they don't do, they are able to reduce the cost. And then the savings can be shared by customer and Southwest Airlines. And that make a business successful. When all the other airlines are in trouble, Southwest Airlines was able to achieve the kind of profit they have, which other airlines were unable to do. Okay, so that's what I call about strategy. Number 3 I want to share with you is make use of the right performance indicators. Performance indicators are important in guiding our direction of our strategy. Many times we accepted our textbook as business Bible. And sometimes inside the business, there are situations that those rules cannot be applied today. Compare the business nature today with business 100 years ago. There are many things that has changed. And therefore, we have to make use of the indicators or the measurement which can be applied to the business model today. For example, 100 years ago, we don't have any knowledge-based company like internet, IC design house. So in our financial management textbook, there's one indicator called return of asset. Now, based on those company or those business exist 100 years ago, return on asset makes sense. It's a measurement of how well the CEO manage the business. Today, we don't need asset, we need people to form an IC design company. We need people to form a software company. Where's the asset? We don't have an asset. Our asset is people. So when we apply the traditional management efficiency measurement, return on asset, this item no longer works. When you apply return on asset for the IC design company, the rate is huge. It's a very large number. So under the old rules or old schools, this would be interpreted, would be explained as a huge return on asset business. And such an indicator or such a measurement does not apply to knowledge-based company. So in today, if we continue to apply return on asset to determine the efficiency of a business, that indicator is no longer true. And we have to adjust them in such a way that we can have a new rules that will help us to measure how efficient a business is managed. And the return on asset can be no longer applied in this case. So we have to move, we have to change. That's one example in terms of picking the right indicator. Number 2, I want to share with you, because of supply chain technology, we're able to move the goods and services in a very tight situation, in a very efficient way. So we're talking about low inventory and low account receivables. But if you look at the financial management textbooks, current ratio to current asset divided by current liability, they said this number, the bigger, the better. Current assets include inventory and account receivable. So that means if these two numbers are big, then the indicator shows the good measurement of the company performance. That is no longer true because our technology in the supply chain has changed all these pictures, all these situations. And we should no longer use this indicator to indicate the performance of our business operation. So current ratio can be applied when the company was 100 years ago, and we can't do it today. So this is another point, for example. And the other thing is like in the cost calculation, we very often confuse with the variable costs and fixed costs. So this also must be fixed before we have a right indicators. Okay, and then number 4 I want to share with you is the product definition. Most of the time, technical-oriented person like to take a technology and looking for problems. Indeed, the situation should be reversed. When there is a problem, how can I find the right technology to solve the problem? That is the right way to define a product. It's not we take a technology and walk around to search for solution, to search for a problem. So we should start out with a problem and then come back with technical solution. That would be the priority. Now, we also very often heard people talk about gross margin in terms of percentage. So sometimes we heard people talk about company A, the gross margin is 80%. It implies this company is great. With knowledge-based company, of course, the higher the gross margin, the better. But for knowledge-based company, it is always true the gross margin is very high because it doesn't involve any materials or the goods. It involves in knowledge. So when you sell a knowledge-based company, it is all gross profit. So gross profit, the high percentage of gross profit is no longer a good indicator of how well the business is. For a trading company, the gross profit margin can be 5%, but the trading company can still be a very, very successful company. For example, like the Li and Feng in Hong Kong, the gross margin is very small, but the volume is huge. And because they manage in such a way that they create a huge amount of cash flow, they were able to make use of the huge amount of cash to generate more investment income. So gross margin itself is a function of type of industry you are in. Okay, so for IC design company, software company, gross margin will be very high, but that's nothing. The question is how many people you use in the organization you use to produce such a gross margin. Because R&D cost is listed after gross profit, so people don't see SG&A cost is the source of the resource that generate the gross profit. So the indication or the measurement of gross margin has to be carefully examined in order to make the right judgment. Okay, so when I teach people on the business planning or business management, I create a new term called return of resources. Resources consist of two parts, hard part and soft part. Hard part means the PPE, the property, plant, and equipment. And then the soft part include those R&D people. R&D people plus the hardware source together generate the gross profit. So if you don't have the PPE, you have the people. So these two together is very much like a Chinese philosophy, yin and yang. Yin and yang combined is complete. So the resource should include the both sides of the resources. Okay, that's one other thing we have to do. Then when the business start to pick up and start to be operational, the very, very important thing is cash flow. Cash flow is the most important thing in making the business sustainable. Everybody have been, everybody know Under Armour, who make the sportswear, UA. The brand name is UA. And UA is created by an athlete, the sports person. UA was very successful until now. The problem I see inside the UA is the inventory increase out of proportion. And that will be the risk or the danger to this crisis to this company. But if the person doesn't understand the importance of cash flow, he's going to get into trouble because of cash flow. And that part is very important. So normally I would suggest to a business, your inventory and account receivable should not grow at a rate more than your revenue. And that's very important to manage your cash flow in such a way that your business is sustainable. The next thing is about the finance management. For an exporting business like Acer or HTC, what is important? Managing foreign exchange is very important. Many companies make money on their main business, lose money on the foreign exchange. Most recent case was like Acer, who make 900 million NT last quarter, but they lost 800 million NT in the foreign exchange. So so the managing money or managing finance is also key to the success to a business. If the business doesn't pay attention to this part, it could lose all your profit. You work day and night, 7-11, but then at the end of the day, you lose all the money because your foreign exchange. So that is also important. And for example, like our, the China Airline or EVA Airline, the majority of the cost is oil. So you got to be able to hedge the price of oil. The volatility of oil could kill all your profit. So if you are not careful, then all your profit, you spend all your time to make a profit and can lose all the money because of the commodity, because of oil prices. And oil prices is very volatile. It can go up as high as 150, can go down as low as $10. So that part is also important in making a business successful. And the last thing, 30 seconds, I want to share with you is, for entrepreneur to create a business plan, the last chapter should be all the information investor needed to make a decision on how to invest in a company. So, and those parts are very important because now, after you finish the business plan and they give it to the investor, this is your return, and I give you opportunity to make this much money. then the investor doesn't have to spend time, and he will be able to make decision based on your proposal. Thank you very much. Thank you.
Ladies and gentlemen, thank you, Dr. James Liu.